Now this is the most interesting ratio which we are going to do in this area, and that is trade receivable collection period. And I call it receivable days because it's easy and shorter. Receivables are my customers who buy from us on credit. The figure for trade receivable can be found in the balance sheet, and it is divided by credit sales. The problem is credit sales figure is never given in the financial statements. You will only have sales, revenue, turnover, but credit or cash, it is never given. So you as analyst, you need to work it out if the business sells on credit or not. Does M&S sell on credit? No? Yeah. If you go to M&S, they will not sell you on credit. They will take cash or card from you. And that is considered cash. So we can say that this ratio is not relevant to M&S. If they don't sell on credit, then we will not. Because if you don't sell on credit, you don't have receivables. Make sense? That's perfectly fine. If you don't sell on credit, you don't have receivables. So this ratio cannot be calculated. So you can decide, but I think there's one more test which should be carried out before deciding if this ratio is relevant for a company or not. And that is, if they have trade receivables in their balance sheet, then they do sell on credit. So let's check that out first for M&S. Going to my balance sheet, we can see that they have trade and other receivables in the current assets, and they also have trade and other receivables in non-current assets. At this point, we need to understand the difference between trade and other receivables. Trade receivables are my customers. Other receivables, anybody who needs to pay us money for any other reason. Maybe we have sublet part of our building, they need to pay us rent, they haven't paid it yet, that is other receivable. We have some money in the bank, they will pay us some commission, some interest on that, that is other receivables. Or we won a case against a supplier, they need to pay us penalty imposed by court, that is other receivables. So these are the few examples of other receivables. We need to ignore other receivables, only trade receivables. We have the figures, so what we should do, we should go to the notes 17 and see what is the real story behind these figures. And this is, whatever we're doing is proper research now. That's forensic accounting we are doing. So going to note 17 here. Trade and other receivable. So first thing, non-current, nothing is trade receivable. So we can completely ignore the figures in the balance sheet for trade and other receivables in the non-current assets. Then comes current, and we can see that there is a figure for trade receivables. If there's a figure for trade receivables, then they do sell on credit. So what's the story here? And you need to understand this whole story to calculate this ratio or ignore this ratio. First of all, they do sell on credit. If you have a credit card, M&S credit card, you use it, you become their receivables. You need to pay that money back to them. So this ratio becomes relevant. Not so fast. Because majority of their sales are on cash and a little bit of their sales are on credit. And there's another note which could tell us if they sell on credit or not. But if this ratio is significant enough to be calculated, if you look at this data, 114.3 million pounds outstanding, customers need to pay us, and compare it with their total sales. So let's do a rough calculation here. What are we doing? We are calculating Receivable Days. 114.3 million pound outstanding in 2018, and the total sales were 10698.2. That is 1% of the total sales. The receivables are so small that they are insignificant. And I tell you something very interesting. Most of the businesses who sell on credit, they make this provision, they make this estimate that every year they will not receive 3 to 5% of their receivables. It is very common. It's called provision for bad debts, people who are not going to pay us, irrecoverable debts. And if their total outstanding debts are 1%, that means it is insignificant. So this ratio is not significant for M&S, and you will see if you're doing a retailer, this ratio is not significant. You should not calculate this ratio and make a statement why you're not calculating this ratio, taking into account all other things which I have just mentioned. And you will get higher marks for doing something like this. Instead, if you just calculate the ratio, which is easier thing to do, I could have calculated this ratio 10 minutes ago if I would decide not to take these things into account. But you will get higher marks for not calculating a ratio because it's not relevant, it's not significant, than calculating the ratio itself. This shows that you are not a machine, you are not a computer, you are doing whatever you're told to do. You are a manager. You can think outside the box. You do things only if they're necessary. But let's say this is significant. Let's say this becomes 5% or 10%. Your outstanding debts are 10%. Those companies who sell on credit, they will have around 10% of their debts outstanding at the end of the year. Then what do you do? Companies like Superdry, Ted Baker, Burberry, these are the businesses who have their own shops, so they are retailers. But they are also seller to M&S, John Lewis and other big departmental stores. For companies like these, and there are others, Apple is there, Apple sells to John Lewis, they have their own stores, Samsung does the same thing. So you will see this situation in many cases. In that case, you will have significant amount of receivables, so this ratio must be calculated. But this complication of how to get the credit sales figure. Companies like these would give you clear information in the segmental reporting. This could be note 2 or any other number, but the word segmental reporting is important. They would clearly give you retail sales and wholesales. You need to take wholesales figure as your credit sales and use that in the equation. So this is proper research work you have done in the last 10 minutes on how to find a relevant figure. And this is the only one of the most complicated ratio which you will be calculating. For M&S, this ratio is not relevant, it's not significant, but I will calculate it anyway. If you look at their segmental reporting, these are the two areas which could be on credit, franchisees. So they're selling those to the franchises, or maybe international revenue. If I do that, even because it's not significant, the debts are too small, so I'll just calculate, take the whole figure. I know it's incorrect, but that's the only time we are calculating this ratio, so I'll do it. So what do I have? I have debts of 114, should not be percentage, a number, 114 and 111. I'm taking the figures from here and divided by my sales, credit sales ideally. I don't have, so I'll take the whole figure. 10698 point. And 162 times 365 days. So result is insignificant. If any business is collecting money from their business customers within 4 days, that is brilliant. But they are very small. Actually, they're not receiving within 4 days. They're receiving in like 40 days. But because the credit sales figure is not available, it's not correct. So I would rather not calculate a ratio which is not reliable, not important, not significant, not relevant.